Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah. In the next 20 minutes, we'll talk all about the high frequency questions in the minds of so many investors and what is the mutual fund route to each of these, right? So everybody's talking about central banking action and the fact that interest rates are being high. So what are the options for mutual fund investors to take advantage or safeguard themselves as a result of this action? So that is part one. Some of you wrote to me about how so many mutual funds are taking approval for covered call strategies. It's happened in the past, it's happening again. And is there any kind of risk to the riskometer of the fund as a result of this? And is that fund still a good option for you? So we'll try and ask our experts about that. And needless to say, in times of volatility come the best opportunities. I'm no one to say this is an opportunity, but what we'll do is try and ask our guests today on the show about, for a really long-term investor, are there some good mutual fund options right now, presuming that you're a high-risk investor? So let's get started on the show. Two gentlemen on the show, Kartik, Jhaveri, as well as Vishal, Doshi, both of them joining to talk about their thoughts. Gentlemen, thank you so much. Much appreciate you joining in.
Pleasure, Neeraj.
Yeah. So Vishal, can I start with you? The first question, the long-term GSECs or the long-term rates are closing in, let's put on at least on the fixed income side, closing around to the 8% mark. I mean, some might be 7.5, 7.6, whichever, what have you. Is this a good idea for somebody to invest in a really long-term bond or a fund which has that kind of instrument in its portfolio and lock in near about 8% return, 7.5%, 8% returns currently, because this may not last? Or is the timing still not right?
Neeraj, hi, good afternoon. As you may know, the best time to invest in a long-dated bond or a gilt fund is when the rates are actually coming off. Now, in the present scenario, the market obviously always discounts the future, but in the present scenario, if you see, the RBI is still in a hiking zone, where the RBI has already hiked rates by 90 basis points, and we may still see further hikes. Having said that, the 10-year GSEC has already moved past 7.5%, which I believe is a fairly crucial level to see from a longer-term perspective. So investors can start looking at gilt funds, but with a horizon of 2 to 3 years, at least, if not higher. And another aspect which the investors should keep in mind is that the geopolitical situation is still very fluid. We are very uncertain about the war, as well as uncertain about where this inflation peaks. So investors can come in this kind of funds in a staggered fashion. In a 3 to 5 month period, they can come into such kind of long-dated gilt funds.
Okay. Kartik, what's your opinion here? From a perspective of somebody, and the reason we thought of doing this piece today was, as so many people are saying that, if you have a 30-year view from a retirement perspective, when will you get 8% returns on a fixed income product? So try and lock in something like that. Now, that's my question. What's your sense around this topic?
So Neeraj, the argument is compelling that, while you see a number like 7.5 or 8, it is extremely enticing to sort of lock it in. But we've seen this in the past. We've seen regimes and we've seen time periods where the rates have been rising. What happens immediately with a gilt fund is that there is a good chance that the investor can even lose a couple of percentage points on capital. Now, once you lose even a 3, 4%, 5% on your capital, because like Vishal rightly pointed out, we probably don't know if the rate hike cycle is done yet. And we are somewhere in the midst of it. Maybe there could be another 1 or 2 rate hikes. Also depends on the international situation and all of that, right? So my sense is that if you get into a gilt fund and then if you're down by 5%, it might take you a year or two just to recover. You see? And that may then not be one of the best things to do. So I would rather that, avoid it, maybe look at the whole situation, how the whole thing, pans out. Maybe 6 months down the line, we'll have better clarity. And then when we see that the interest rate seems to have stabilized, then probably that would be a good time to go into gilt. So Vishal said 3 to 5 months. I would quite subscribe to that concept and that methodology of buying, saying that let's wait and watch before we really rush in and look at some of these gilt funds and things like that. They can be volatile. We have seen capital losses also here in the past decade or so. So we've seen this kind of a situation happen. So I wouldn't recommend to rush.
Okay, so For somebody who has got money, Kartik, to you first. Somebody
Yes.
who has got money does not want to put it in equity funds, right? And wants to stick asset allocation between equity and fixed income alone. Yeah. What is the fixed income option then?
So there are a couple of fixed income options, right from a short term to a medium term to a long term. Now, if it's a pensioner or a senior citizen of that sort, let's say if he's got a sizable amount of money, he can consider annuity plans and pension plans, because there, once you've invested the money, then there is almost sort of a guaranteed lock-in that the money is going to be in for a long time and you're getting an annuity paid out. So that might be one of the longer term options. Like you mentioned a while ago, that saying if somebody wanted to lock it in for a 10, 20, 30 year, then annuity plans are a good option. Now, the moment the rate hike happens, these annuity plans also revise their rate upwards. Because of that, that's a good opportunity for them to get into. In the medium term, you might have to, do with some AAA rated corporate deposits and things like that, so that you are kind of okay. And in the short term, there are things like peer-to-peer lending also, which you can consider to a small extent, because that also gives you a rate of interest which is almost double to their debt funds. There is a lot of noise and knowledge around the whole thing, which is kind of intertwined with each other. But I think that's an interesting option.
Okay. Vishal, what would your thoughts be for somebody who's only wants to do in fixed income?
Sure. I think for fixed income, as Kartik mentioned, there are a few options. One of the option which I actively look at is AAA rated bonds. So, which I feel bonds of large corporates, I think they are a safer bet and they offer good yields as well. So, but that is from a medium term perspective.
What would the yields be, Vishal? Sorry.
Yeah, AAA rated will be anywhere around 7% or 7 quarter types. There's a good chance to get that kind of yield. For somebody who wants to take a slightly higher risk, they can go for say MLDs, which are market linked debentures, which are also 100% debt oriented, but definitely not AAA. But yields will be much higher, which will be around in the range of 9.5%. So that is the two option. Plus the classic corporate deposit, which is very popular with retail investors as well as HNIs. So I think that is one option where corporates like PNB Housing, HDFC, Bajaj Finance, all of them have their corporate deposits. So I think these are the options. Plus now some exotic debt instruments are also coming in the market. Some related to green energy, some related to bill discounting, and so I mean this can be looked at, but obviously it's a very smaller portion of the entire portfolio.
Got it.
I think these are the only options available for debt investors.
Okay, because we kind of went on beyond the mutual fund route as well, but I think it was important in the current scenario because, as our guest said, that the options are probably few and far in between, and very few which might be the correct fit in the current circumstances, essentially. So I hope viewers, you got a sense of that. Maybe take that advice seriously and try and study, and then take a decision to invest. The next question, and Kartik, I'd like to start with you on this one.
Yes.
And that's what some funds are doing. So I think Parag Parekh at some point of time in the past had taken this option or approval to do a covered call strategy. We now had the DSP Quant Fund do it. A couple of other funds have also done it. And I think a lot of people, when they see that an email coming in or otherwise, wonder that why is the fund doing it, and is the fund still therefore remaining within the same risk parameters that they would want to invest in a mutual fund scheme in? How would you respond to that?
It definitely changes the risk element, maybe by not a huge margin, but there is a difference there. Essentially, for the benefit of viewers and everybody else who's hearing in, just to make it really simple, what's happening is that these options, that covered call options, which some of these mutual funds might take, that is done to increase the return on their investment. Basically, there will be a time, and there is always a time, where sometimes the stock market doesn't move or a stock doesn't move. It moves sideways. It's in what we call as a sideways moving market. It goes up, maybe 5%, comes down 5%, but it's in a band of sorts. Now, in this kind of a situation, the wealth growth or the appreciation doesn't happen. So what they do is they sell options. When they sell options, they get a premium. So long as the market remains in that sideways band or in a particular zone, the fund tends to make a little bit of extra money. It's income to the fund and therefore a positive benefit to the NAV and therefore the investors. But having said that, there could be instances where the markets, like what we saw a couple of days back, suddenly like a 500-point drop on Nifty or like a 3%, 4% movement. Now, at that point of time, stop losses for the funds also would get triggered, like retail investors. And there could be, khaya piya kuch nahi and unnecessarily loss kar diya, that kind of a thing. So that is what sometimes these covered call options can do. So does it change the riskometer? Maybe yes, marginally. It does change it, however. But does the strategy of the fund kind of change radically? Absolutely not. If it's going to be like, since you mentioned Parag Parekh, if their objective is long-term equity growth, and that's exactly the name of the fund also, then it will stay intact. I mean, all the fund managers would like to do that, but they're trying to augment the returns of muted times or times where the NAV will not change dramatically. So not a bad idea, all right, as long as it is done within some controlled parameters and within a predefined sort of limits, which I'm sure they are doing. So I think investors need not worry too much about it. It's not a bad idea, but remember, there is a risk to it. If the market suddenly trends upwards or downwards, either ways, there could be a loss.
Vishal, do you get worried or nervous when funds do this? So what's been your experience, and what would you tell your clients if they were to ask you this question?
Neeraj, definitely, I think when any scheme indulges in derivatives, I think the risk will go up by a notch for sure. Howsoever safe the strategy might be, and howsoever lower the limits might be of doing such a thing. But just to tell the viewers, a covered call is actually a derivative strategy where the investor is basically writing call options, on a stock which they are already holding. So in a scenario where the market really shoots up by say 5% in a couple of days or in a day's time, there is a chance that such a fund might end up making some kind of a loss, although they have a cash position to that extent. But derivatives will not move by that much margin, so there is a good risk that there might be a loss in such a strategy. So I would rather not have a fund doing this. I mean, I would rather be more happy with pure long equity kind of portfolio and look at other ways of doing this covered calls or other derivative strategies.
So if your clients had, say for example, any of these funds in the portfolios, would you go so far out as to tell them to move out of those funds and move into other funds because of this?
Not exactly tell them to move out, but at least definitely I will tell them to be cautious on this kind of funds.
Okay, fair call. But not a, so viewers, that's the thing. At least in Kartik's view, it's not a very material event because the funds will be responsible in the extent that they use this. Vishal is saying that they probably do this, but he is not completely comfortable. So people need to be cautious about when they choose to continue the investments into funds like these, which brings us to probably the most important question, the most difficult one to answer, but one that I will ask our viewer, will ask our guests, and that is, what should somebody who is a high risk appetite investor do, or what's the choices that the high risk investor has in the current times? And Vishal, I want to start off with you. Here's an investor who's looking to invest for the long term. She has a high risk appetite and she has the longer term thought process in mind. What would you advise her to do? What kind of funds can she put money in and why?
Neeraj, if the investor is a high-risk investor and has a sufficiently longer-term horizon, say at least 5 to 7 years, at least. So I think for such an investor, I would advise, pure equity funds, which would be in the category of, say, flexi caps, mid caps, and small caps. So I think I'm very clear on that the India story is here to stay. And if an investor has that kind of appetite, then he or she should go for such kind of funds.
Okay, and what within those categories? So for example, if you're recommending flexi cap or mid cap or small cap, and this will not be an exhaustive list, Vishal, but one or two names out there, out of the many that you may be recommending, but one or two names that come to the top of your mind.
Investor can look at, say, a DSP flexi cap or a Franklin flexi cap, or say a long-standing fund like Nippon India Growth Fund.
Mm-hmm.
Or maybe in the small cap, something like ICICI Prudential small cap or Canara Robeco small cap.
Okay. And sorry, just one more follow-up, Vishal.
Sure.
Is there a particular reason why you like some of these funds versus the others?
Some of these funds do have a long history. Like, for example, Nippon India Growth Fund has a long history. and some of like DSP FlexiCap has a long history. So I
Okay.
think these funds have shown performance in the past, and they have good fund managers to back them.
Got it. Okay. Kartik, the same question to you. This investor, she has got a long-term horizon and she's not risk averse. She has a large risk appetite. What would you advise?
Neeraj, for her and for everybody else also who want to do something different, the standard operating procedure remains the same, that buy your large cap, buy your mid cap, buy your small cap, buy some flexi cap. What I like to do is, out of the entire 100 rupees that is going to be put to a mutual fund, I like to tell my investors that, think about 30 to 40% into sectors, play themes. Okay. So for example, in 2020, post the COVID fall, the theme that was to be played and which we did play was the pharma theme. Okay. And all investors made a huge amount of money. They made huge gains in pharma. So pharma was a suggestion made and, investors accepted it. And I think history shows us that pharma did superbly well. So in that sense, there are always periods and phases where, one sector or the other sector might be shining. Now, for example, commodities is another very interesting space. Infrastructure is an interesting space. Infrastructure from a domestic as well as an international point of view. Commodities more from international than domestic, because if you start looking at things like food shortage, you start looking at wars, what happens as a result of all this is there is a lot of latent demand for a lot of these products. So we will supply steel. Our steel manufacturing companies will export a lot of steel. We will export sugar, although there have been temporary, supply side economics playing in, and as a result of which government has had some policies. But that is not like a permanent thing. So if you want to play an interesting and a very, sort of a powerful theme, if you like, then there is commodities, infrastructure, banking, for example, is a theme which has not played out for a long time. You see, so somebody, like her might want to consider banking fund. Every other sector has gone up far more ahead than the banking sector. Now, with interest rates going up, sometimes these banks who are actually, you may think that as an investor, you're going to get more, but as a bank, they're going to earn more interest when the interest rate goes up. All our home loans and all other rates go up. When they move up, banks make money. And that's the time one should consider things like that. Look at the US market. US market has fallen dramatically, much more than our markets. So there is S&P, there is NASDAQ, there is an international theme to do. Again, there's some RBI embargo on that for the time being, but it's not going to remain forever and perpetually. So international is also a theme that you might want to think about. Now, see, these are the things you can say, 30 to 40% of your mutual fund portfolio, one could be a little more active than the usual one. So 70%, let's say you have your flexis and mid cap, large cap, small cap, the traditional funds, we keep them and, we hold them, match with our financial goals and so on and so forth. But then another 30%, you can play on these interesting themes and ideas.
So let's say if somebody is wanting to play the banking theme, Kartik, what are the funds that you guys are recommending? Again, not an exhaustive list necessarily.
Yeah, I mean, I don't like to endorse any particular fund, better than the other. But having said that, banking or pharma, or for that matter, real estate, or for that matter, commodities, virtually every fund house has got some funds here. And their performance is almost sort of equal to each other. So there's value research, there's money control that investors could look up, of course, consult your own advisors as well. But everybody has these themes. But these themes have much smaller AUMs compared to the AUMs of, funds like the pure blue chips and the pure large cap funds. But these are places to actually explore to get that additional alpha that you might be looking in your portfolio. And if you're prepared to take a little bit of volatility, then these are the places to go.
Fair call. Jaman, we'll leave it at that. Thank you so much for taking the time out and being with us on the Mutual Fund Show today.
Thanks, Neeraj.
Thank you.
All right. And viewers, thanks for tuning into this leg of the MF Show.